Good evening, everyone, and thank you for taking the time to join me once again. Um, for those who do not know me, my name is Sara Waqar, and I've spent over a decade in the financial markets as a prop trader and as a financial mentor with a focus on currencies, commodities, and stock indices. I'm licensed from FINRA in USA as a commodity and futures trader, and I'm also accredited which is in line with the UAE ESCA regulatory requirements for an investment manager. So I've worked very closely with traders and brokers over the years to help them understand how to decode the markets using very simple but consistent approaches. I've also been involved in financial journalism, where I've investigated fraud cases relating to the financial industry. And I have been giving private and trading courses since 2015 to individuals of all different backgrounds to build a disciplined approach to trading. So, Amana is a brokerage which has been around for 15 years. We have a 15-year track record. We offer more than 5,500 financial instruments which range across all asset classes, whether it's regional stocks or international stocks or currencies, commodities, stocks, which are both leveraged and non-leveraged. And yes, so we have multiple regulations which include local regulations as well as international regulations. So we have the DFSA from UAE, we have the SISEC from Europe, we have CMA from Lebanon, LFSA from Malaysia, and we have FSC from Mauritius, and we also have ESCA from UAE. So before I begin today's topic, I just want to remind you that you can drop your questions in the Q&A section that you see below, and I will try my best to answer them. If you want to contact us, you can email us at support@amana.app, or you can call us, you can contact our live support through the app or through the website, or if you have an Amana relationship manager, you can reach out to your relationship manager. Today's topic is about how we are to allocate across different asset classes, which are commodities, equities, and digital assets in times of crisis. Today, we are going to talk about something that frankly is very surprising and it should not be happening, but it is happening. So we are going to talk about, the different macro trends that we are observing in a very conflicted geopolitical situation, which are counter to normal economic theory. We're going to talk about how in this situation we can allocate our money across commodities like gold, silver, equities like S&P 500, and digital assets like Bitcoin in this time of crisis. But most importantly, we are going to understand why the current market is behaving in a way that the traditional economic models cannot explain anymore. So we are going to first look at the macroeconomic environment that we are in. We're going to try and understand that. And then we will go and look at how each of these asset classes is behaving. And then we will go into a deeper correlation between these asset classes. And finally, we'll talk about how to actually allocate your capital and how you can trade in this kind of an environment. So let us look at what's the macroeconomic environment right now. And right now, we are in an environment with high interest rates, persistent inflation, and ongoing geopolitical tensions. So let us first discuss the interest rates because they are very important. After COVID, as you know, the central banks, especially the Fed, kept the interest rates near zero to support growth. But in 2022, from 22 to 23, inflation surged sharply, and that was because of a loose monetary policy and a lot of printing from the Fed. So this actually led to This actually led to a hike in the interest rates. And let me just show you what has been happening to the interest rates now. Um, yes, this is the chart. So as you can see that the Fed's fund rate till now in 2026, as of now, is around 3.64. So even though it has come down from 5.25, which was the highest, we are still in, that we would still not say that these are low levels. So this is considered restrictive, meaning that borrowing is expensive and growth slows and the liquidity tightens. And the market impact for this should ideally be that stocks should face pressure and crypto should become more volatile and US dollar should strengthen because people would want to invest in government bonds because they are giving a higher savings rate. Secondly, we talk about the inflation. So the inflation is also quite high and it peaked during COVID. That was about 9%. Then early 24 to 26, it cooled to around 2.4%. But right now, because of there has been a war-driven energy shock and inflation has now jumped from 2.4 to 3.3% in just 1 month. So we have an environment of high inflation as well as relatively high interest rates. And the main driver of inflation is the oil prices, which surged 50% in weeks, the Strait of Hormuz disruptions, and all this and inflation which fed into transport, into food, into manufacturing. And so the Fed has a 2% inflation rate, and this rate that we have right now is still considerably above that rate. So the result is again that the markets are very volatile, they are data dependent, and the risk assets like crypto, like stocks are moving very sharply on the macro news. Commodities like gold and oil are reacting very strongly to geopolitical headlines. This is basically not any traditional crisis. In the past, there used to be just one dominant factor, but today we are dealing with a combination of different factors. So we have inflation, we have a tight monetary policy, we have the fiscal imbalance, we have the governments running large deficits, and we have the geopolitical tensions across multiple regions. So we have the Russia-Ukraine war, and we have, the current situation as well. And so there are a lot of things here together, and it's not just one problem. It's an overlapping system interacting with each other. And historically, what happens is that such kind of an environment should create a lot of market stress. You would expect risk assets like equities to be struggling in such an environment. You would expect liquidity to be tightening and defensive assets like metals to outperform. But if you actually see the picture, the reality is very different from that. So for that, I would like to just give you an overview quickly. Let's go to the trading platform and let's see what has been happening overall to these three basic asset classes. So for metals, I'm going to just use gold as a benchmark, right? So this is gold right in front of you. And yes, in order to be able to see a macro trend, you definitely have to be on the higher time frame. So I am selecting the weekly time frame from here, where one bar is representing 1 week, and on the horizontal axis, you would be able to see at least a few months, actually over a year's data. So you need to see the trend over at least a year or so to be able to understand what is the actual direction. And if you see this in front of you, I think it's pretty clear to you what is happening to gold. So I think that nobody would argue that this is not an uptrend. Actually, it's a very clear uptrend overall. So if I go to S&P, which I'm going to use as a benchmark for equities, S&P 500, which is a representative of the US stock market, it includes 500 top US blue chip companies by market capitalization. And it gives a lot of weightage to a few companies which invest heavily in tech and in AI. So here, this is the S&P 500, again representing the US stock market. And again, on the higher time frames, we're able to get a very good picture of what is happening. So S&P is on the all-time highs again, very bullish, very positive. Next, I'm going to see what's happening with Bitcoin. Okay, yes. Again, using it as a benchmark for cryptos. So here, what I see is there was definitely a very major, loss in value of Bitcoin from this high of around 126 that we experienced, in October down to $60,000. So it lost about more than 50% of its value. But what I see now is certainly a bounce back. So this market is not like something that I can very confidently say that it would resume, but I am going to get into more detail about what really we can do, how we can invest in this market and what are the important or key levels to look for, which would make you certain that yes, this is the start of another bull run. Show you the daily time frame, then again I am able to see this a low which is higher than the previous low, and definitely I see this important level which has now been crossed. So I see a lot of bullish signs now in the market, but whether this is going to be a bull run or whether the market would consolidate for a while, that is something that certain technicals and price action will have to decide. But definitely, I do see the bullishness coming back Bitcoin as well. So going back to where we were, I'm going to discuss that, what it would be expecting in such an environment and what is the reality. So there is actually a gap between the expectation and the reality. What we see right now is that the current reality is still high interest rates and economic uncertainty, which are tight conditions, which mean that, like I said, equity should not be performing well, etc. But on the right, you have what is the reality. And the reality is that the market is actually pricing future policy cuts. So you would be surprised that, markets can actually sometimes just completely throw the traditional economics away, and they can be behaving very differently because markets are sometimes pricing the future much more than the present. And this is what's happening. So the market seems to be anticipating future interest cuts, and this is what it is pricing right now into the equities. Apart from that, the market also seems to be pricing expected future liquidity and liquidity injections into the whole system. So because of these reasons, we see a lot of money still flowing into equities because of these positive expectations as well as into metals. And so the reasons are actually completely different, and I'm going to discuss all of these reasons. But, expected increase in liquidity in the future is a very important reason that you need to keep in mind, and is being expected across the board. So again, traditional economic theory is breaking down, and high real yields are failing to suppress assets. So we have to see the markets, whether it's for the metals, whether it's for the equities or for the cryptos, in a new lens. We just cannot use, economic or certain financial principles just to predict them. Now, I'm going to start with the gold, which is, I know, of a lot of interest to a lot of people, and many people want to know what, could happen, whether we should invest, whether we should not, what might be the future of gold. Right now, that gold has always been a safe haven traditionally, and it performs well when the rate of inflation is high. It performs well during geopolitical uncertainty. It performs well when the currencies are debasing and under pressure. But what is strong is that even with right now with the interest rates being relatively high, gold is strong. So normally with high interest rates, you would expect gold to not, to be under pressure. So again, let me go back and let me show you the price chart for gold. Like I have made this point before, that if you want to get a really good idea of what is happening to the overall macroeconomic trend, it's very essential for you to first go on the higher time frames to be able to get an overview of the market. And if we go and if we see, we look at the overall trend and direction of the market, that shows that there was a massive correction, which I am sure a lot of people might have thought of as a downtrend. Yes, it can be thought of as a downtrend if you are an intraday trader or if you're a short-term trader. Then this entire price movement that you see here over 3 weeks would definitely look like a downtrend. So if I go on any smaller time frame, even if I zoom out a bit on the daily, this part here does look like a downtrend. And let me just put a reference line here, a vertical line. Let me just put a line of reference so then I can go to the smaller. Yeah, so looking at the 4 hours, then this is a downtrend, but your perspective definitely will change when you see the same asset but over a different period of time. And it's very important for you to be able to understand the difference between macro trends, which are long-term trends, and short-term trends. So again, in my opinion, this was just a correction followed by a very strong rejection. So this candle with this long wick is giving you a very important, significant bullish sign. It is basically rejecting lower levels. It is saying that the market for gold actually rejected closing at lower price levels and then closed higher. So this point for me would be, this area of the chart is very important for me, showing me a lot of bulls coming into the market. So again, what we see is a resumption of the uptrend here. And I think some of the reasons are very clear. One is, of course, that this is, risk of assets. We have a lot of instability. We have tensions and the war situation and the global conflicts, and investors are seeking safety. And gold will always benefit in this situation because it's not tied to any single economy. It's not a liability of any government. This one reason is the fear, which is driving this market. The other important reason I could give you is the inflation, which is high, so the real interest rates are low. Real interest rates are interest rates adjusted for inflation, so it's the interest rate minus inflation. So actually, it's the real interest rates which matter. So if the real interest rates are low and people are not they do not want to put their money in the bonds or put their money in the banks, then the alternative that they would find is gold, and gold would in that sense become more attractive for institutional investors. Then I have already talked about inflation. People want to hedge their gold is considered to be a hedge against inflation as well. And one more very important thing, which most of you, I'm expecting you to know, is that the central banks across the world have started to de-dollarize. They have started to become major buyers of gold to the extent that the Bank of China has doubled its gold reserves. And that's obviously to diversify away from the dollar, to reduce the risk of the sanctions, to strengthen the monetary independence. This is creating this consistent structural demand for long-term demand for gold. And again, we have the institutions which are actively relocating their capital in these uncertain macro conditions. Exposure to equities and risk assets is usually reduced, and they would go more towards defensive assets like gold. A lot of reasons why we see gold strengthening. Now, after having discussed this, let's go back to the equities. Now, it's again, like I said, counterintuitive, but the equities are rising as well, along with gold, whereas traditionally there's supposed to be an inverse relationship. But now we need to see, why is this happening? Why are equities too rising despite all of these problems in the economy? Now, the most important thing which I feel is why S&P has shown such remarkable strength in this time period is because of the AI earnings growth, which is the primary driver. So the biggest structural force behind this rally is the AI boom that is being experienced right now. And that is a very real thing. It's led by companies like Nvidia and Microsoft and Apple, and these firms are experiencing explosive revenue growth, strong margins, massive capital inflows, because it's AI is not just a hype, as we know now, it is driving real earnings. And secondly, when we just specifically talk about S&P 500, we know that it's weighted according to the market capitalization. So a small group of mega cap stocks takes a very high weight in S&P. So because those stocks are performing so well, so that is why you see that S&P is it's at its highest high. The third very important reason is the passive flows. So what are passive flows? The passive flows into S&P are coming from the ETFs and from the index funds. And I'm sure a lot of you must have invested in these funds. So these funds track the S&P 500, and that creates continuous automatic buying pressure. Because when investors allocate money to these funds, then these funds have to buy the index constituents, and this creates a constant buying pressure, regardless of whatever is the macro picture behind. So the more money flows in, the more large cap stocks get bought, the more they outperform. Let's go back and just to show you again. The most interesting market and the most tradable market ever, in my opinion, is this market. It's beyond any doubt a very bullish market right now, and it has been so for the past so many years. It has been like that for over a decade now. If you were to ask me, as a trader, not as an investor, but as a trader, what would be right now the best way to trade this, then what I can suggest to you is that right now we are at the highest high. I would always wait for a corrective dip to happen in a market which is strongly bullish, but it is at its highest point, and would be more confident taking an entry once I'm sure that a sufficient corrective dip has happened and the market is showing signs of resumption. In this particular case, the level that I would be interested to buy now. So if you ask me, Sara, if you were to trade, would you jump in the market right now? I would say, no, that's not a good idea. Again, because a lot of gains have happened and there might be some profit taking, so there might be some correction, or the market might move up. But if we need to take a long-term entry, then I think that a good level for a long-term entry would be this level. So again, you could actually, because this is a previous resistance, which will now turn into a support. So this approximate level of around 6,900 is an interesting level where if the market comes down and creates a strong bullish sign or bullish price action, it would definitely be a good buy. There can be other ways also of looking at this. The market might not just correct to that level right now. It might just consolidate here, but then that's another story. It's another discussion, and that discussion is about, how we read price action signals in the context of the trend. But again, if we do see some nice dip here, followed by a bullish price action signal, then it is actually a good market to be in. Somebody has asked me, anonymous, yes. You attend the webinars very regularly, I know. Realistically, this is just gambling. You never know about how low an asset can go, especially with the high leverages. Teaching this to everyday consumers is predatory. Okay. I think that you have your own perspective, and I'm really glad that you asked this. Okay. See, I know that most people in the market, are losing, and especially when they're using leverage, they are losing. But there is a reason for that, and the reason is people you do not go into the market with a proper plan and with proper risk management. So trading is not just an overnight thing. It is something that requires. It's a very serious business, and it requires a lot of study, a lot of time, a lot of energy, a lot of practice, a lot of experience, a lot of failures to actually start understanding what you have to do to be successful. And yes, definitely that's not an overnight thing. And I do agree with you about the part of leverage. I think leverage definitely does more harm than good to retail traders. But I I have had a previous webinar. I don't know if you attended it. It's about risk management. And in that webinar, I explained to you that if you do your proper risk management and you know um, restrict your risk per trade, then the leverage does not matter, and the leverage is not going to harm you. So, for example, it is in my hands to restrict the leverage, to restrict my risk on this trade to any amount. I can restrict the risk on this trade to $1,000, to $2,000, to $500, right? And where people are mostly going wrong is that they are not restricting, they are not doing proper risk management. I'm not going to talk about the market, definitely. You are right in saying that, predict the market with 100% certainty. But there are certain ways which do give you an edge. For example, looking at the longer time frames, that gives you an edge because the longer time frames are actually where the overall fundamentals are playing out as opposed to intraday trading, which is more noise. So this is actually a long discussion, but what I want to stress is that people mostly lose money because they are not restricting their risk. They're not putting the stop losses on every trade. So in the last webinar, I discussed that how much more important risk management is than predicting the markets or studying the markets. How important it is to have a stop loss on every trade and a very calculated position on every trade, because anything can go wrong. So this is something that you must understand if you have to trade. I'm getting more questions, but I will be answering them. Let me proceed a little bit with this, and then I will be answering your questions. I want to move on to Bitcoin. And so Bitcoin, as you know, it's the largest crypto asset. It's a benchmark for the entire crypto market. It has the highest trading volume. It has the deepest liquidity on all the crypto assets. So it started off as a very speculative asset, but then it became an institutional asset, and now it's a macro asset. What is basically, we need to understand that what is basically driving the price dynamics of Bitcoin now. So before that, we need to understand that Bitcoin again has a dual identity. Everything started off, people said that it was something akin to gold, so it was the digital gold, and then other people think of it as a risk asset. But in actuality, it has a dual identity. So it is both. So on one side, it does behave like a risk asset. It moves with equities during periods of liquidity expansion. On the other side, it behaves like a store of value. It aligns with gold when there is macro stress. But to be honest, I think that actually has its own path. So it is not correlated, strongly correlated with either. So there will be small periods when it will show correlation with equities and smaller periods where it will show correlations with gold. But the more important thing to discuss is the halving events in Bitcoin, which I think is they occur every 4 years, and they kind of slash the block reward for the miners by 50%, which creates a very big supply shock. So when that supply shock is created, the market plummets, and then there's an accumulation phase, which is followed after some time. In between those 4 cycles, in the middle, it's followed by a bull run. And this is what we've been seeing before. Okay. Again, the old cycle, the old understanding of Bitcoin was that, it's the supply side which is going to exclusively drive the price. But what we understand now, that no, it's not just the supply side, it's also, the demand side. It's also the institutional side. It's also the macro side. So let me go back. Let me go and show you the chart for Bitcoin. Now let's do a bit of discussion about, what's happening there. Okay. Yeah. So, like I said before, that it is, in my opinion, it is a very speculative asset, because the way that it corrects, it loses value by more than 50%. But then again, for such an asset, a 40 to 60% correction is now being considered normal. If I look at the technical structure right now, which I did comment on as well, and I just go into a bit more depth when I go into the daily time frame, I see that the bullishness has returned because certain levels, important levels, have been breached and they have been crossed. If I am to be more sure about the bullishness of Bitcoin, then at the current level, I would actually like to see it push past this level. Why? Because this same level of around 78,000 was a previous support, which might now act as a resistance to the market technically. But if this resistance is broken, then I will definitely be more confident about seeing a surge. So, yes, so we have to observe this level closely. And again, we see that this was a past resistance. So you can see here that this was a previous support, which might now act as a resistance. And if the resistance is broken, then I would definitely see a bull run. And yes, if you want to ask me about, how high it can go, that really I do not know, but I can give you some predictions that, some institutions and banks are looking at 200,000 level if it does get into the bull run. But then that's again an estimate and nobody really knows. And what we have to do is we also have to clearly keep observing the price action, and we have to keep observing how Bitcoin is behaving at key levels. For example, this is another key level at 96,000. So we might see a stalling at 96,000, or if it breaks past that level, then again, we could be seeing another bull run now to the previous peak. So again, technical observation is as important as the fundamental backdrop. So towards the end, I just want to say that we can see that there is a breakdown of these traditional correlations between asset classes. In the past, gold and equities were thought to be negatively correlated. We see that that's not the case anymore, and Bitcoin and gold had a weak relationship. Now actually they have don't seem to exhibit like any relationship, and they just they beat to their own tune. So relationships these days have to be taken, they have to be studied according to that particular instrument's own supply and demand, particular factors, as well as the way that people are currently responding to the macroeconomic environment, whether they are pricing the present factors or whether they are pricing the future factors into these markets. One thing which is important right now is that why everything seems to be positively rising together is the global liquidity expectations. And the one reason why all the market participants are, all asset classes are being driven is the higher liquidity expectations, because people are anticipating more capital inflows into all of these assets. So not only is it happening right now, but there is future positive anticipation of these liquidity injections. And So people might be reacting to the fiscal expansion. They might be reacting to the fear of the crisis, or might be reacting to the long-term currency debasement concerns when it comes to gold. You know, they might be reacting to positive capital inflows and the AI bubble when it comes to S&P. So this explains the paradox that we started with, that why does everything seem to be positive. And I've explained to you in detail that why gold is rising, why equities are rising, and why Bitcoin might also be rising, both because of liquidity and scarcity. So this session, and in the end, it's just the thing that we have to remember is that we are in the middle of a very complex macroeconomic environment, and which has caused all economic principles to fail, the correlations that were typical between major assets. And so allocation must adapt dynamically to individual factors in each of these asset classes and to the overall macroeconomic conditions. And if you are a trader, then the best way is to analyze the prices as well as the macro environment of each asset class separately, and take into account the major key levels, which serves or supports in the past. And also, you time yourself accurately. Do not just jump in the market, wait for proper dips, wait for the proper price action signals to form that is suggestive of a rebound or a resumption in the trend. And the most important factor, again, what is execute risk management, which is more important than anything else, which is to restrict your risk per trade, to put your stop losses according to the market and not where you want to put them, and then to work your way backwards to position sizing. So if any one of you wants to understand how I do risk management, I have discussed that in detail in the previous webinar, and you can find recordings for that webinar on our YouTube channel. So now I'm going to be looking at some of the questions that some people have asked me. Okay, under the current situation, when USD can quickly lose its real value and world currency status, what assets would you advise to invest in if not stocks? Okay, Usher is asking me. I think, Usher, it's a very, in my perspective, I think it's a good idea to invest in metals right now, especially in gold and silver, because I feel that, it has always been stable in terms of a traditional hedge, and it has always held that that idea, or that a traditional hedge. So I think that it could be physical, or if you are trading, then it could be just you could trade gold, or you could also hold physical gold or silver. So I think that's one good investment that you can do in this situation. If you go for other kinds of assets, then again it's very important for you to diversify your risk. For example, if you are putting some money in Bitcoin, then again you need to be able to understand the volatile nature of that asset. You need to do your risk management accordingly. So if you are asking my opinion, you're asking me that if gold is already overpriced. So in my opinion, I do not believe that it is overpriced, because I think that inflation and currency debasement is an ongoing process. So definitely, I always see people having this concept that this market has been going up for. It has been going up for so long, and then it has to come down from somewhere, but that does not happen. And the reason for that is that inflation is a very ongoing process, and so is other things like technological and advancement, which is what really has kept S&P going up for over a decade. So I think if you feel that market has been bullish for so long, and just because it has been bullish for so long, and there is not a very strong reason for you to think that it might turn around, then yes, it can continue to be that way. Okay, Heather has asked me, as for seeing weekly and daily trend, is it best to get further complete confirmation from 4H and from the 4 hourly and 1 hourly time frame and use these time frames for entry? Okay. Heather, if you are an intraday trader, and I believe if you have very strong risk management in place, then I can say that yes, you can definitely use the 4 hourly and the 1 hourly, but then I would say it should be a point of confluence between these time frames and the higher time frames. So if I find a point of confluence where the 4 hourly is fitting with the daily is fitting with the weekly, then that you can definitely take such a trade. And yes, you can look for confirmation signals. You can fine tune your entries through the 4 hourly intraday, but then again, overall, it has to align with the broader trend and with the more important support and or resistance levels, which are better defined on the higher time frames. Again, the key levels, you have asked me, how do I find the key levels? It's just very simple. I would always go to the higher time frames, which especially to the daily time frame. So I can show you that if this is Bitcoin, and how do I know which are key levels? First of all, depending on the market, I would either use the daily or the weekly chart. It depends on its the way that it is formed or how smooth it looks to me. So for Bitcoin, because there's more volatility, I would rather have an even bigger picture. So I would go to the weekly. And how did I draw this line again? I saw that there was a previous support here, which can obviously now act as a resistance. So you don't have to necessarily use the weekly, you can use the daily time frame as well. Again, this is a peak here. So this peak is another important point for you. So if the price pushes through this level, then again, it might encounter resistance on this peak. Then let me draw another other support and resistance lines. So it's not any rocket science. It's just, the way that you draw the line is that you should try and touch the maximum number of candles here. So it's like an average support or resistance zone. So again, I have one point here. So this entire zone, so I'm talking about this peak here, right? So this entire zone from 106 to 109 is the next resistance level, and then followed by the next resistance level, which is approximately, I would regard all this to be about one resistance zone. So the next resistance zone is the previous peak, which is 122, 126. And if that is broken, then we will see another high being made. Okay. What is your view and go about the day? Okay, what is my view about day trading? Okay, so my view about day trading is that I started off as a day trader, and I worked as a trader for quite some time. But now I am mostly a swing trader, so I'm mostly working on the higher time frames. And the reason for that is that I feel that we need to take quality over quantity. And what I feel is that the higher time frames are because kind of they're able to condense more time period. The candles are able to condense more time period in front of them. They are able to give you a much more stable and a much more better perspective of the market, which holds. So, for example, if I'm on a shorter time frame, which does consist of a lot of daily noise and unimportant factors which keep moving the price up and down, many signals that will form on the smaller time frames could be false signals. So if I'm looking at the daily, my perspective would be completely different, right? I would say this market is going up, but if I'm on a smaller time frame, like 30 minutes or 1 hour, my perspective would be completely different. I would say, no, this is a downtrend. But then again, what really holds and plays out in the long term is not is basically the structural trends, which tend to hold over more time. And since we are looking for kind of a strategy which is more predictable and more consistent over time. So the entire point is to be successful, to have to uh, increase your trading account over time, to increase your funds over time, rather than sometimes getting confused and playing with short-term signals. So again, yes, like I said, you can do intraday trading, but it's best if it is aligned. The direction of that trading is aligned with the long-term trends, and the confluence points or the important points that you're looking at also are those kind of points which which have proven themselves to be proper support or resistances on the higher time frames. So I know everyone has their own perspective. I'm not completely against day trading as well, and I know that some people are like very good at it, but I think that what is more important than price prediction or charts or everything is again the way that you manage your risk. So if you are not over trading, if you are very sure about why you are taking that trade, even if it's on the shorter time frame, you are very sure about the trade, you have a proper plan, you know why you're taking the trade, why you are entering there, where you are going to exit, your exact risk level, then yes, definitely you can day trade as well. I see that most of your questions have been answered by my colleagues, but I am looking for any other question. All right. So I think I've answered most of your questions, and right. So I hope that today's webinar was educational for you, and I would like to see you next time. Again, we have one webinar coming on Tuesday, which is about how we read long-term trends. And Heather, you might want to actually attend that because it's going to answer in detail how we read long-term trends and how we mark supports and resistances and areas of interest where we want to make our entries. And on Thursday, we are going to discuss about the relationship between gold and silver, and we're going to get into more deeper technical analysis about how we can actually take entries, what are the kinds of price action signals that are more high probability, which will help your trading become more profitable in the long term. So thank you so much, and I will see you next time.